Good morning. It's 8:01, December 17th, and I'm Vince Lanci. This is the Gold Fix, sponsored by Opportunistic Trader. Um, and we are going to be discussing quickly today a little bit of technical analysis, a little primer on technical analysis, as I myself am not a believer, but I'm going to take the other side of it. Um, No materials today, but there is plenty of content. We have a technical analysis report from Goldman Sachs that we're going to look at, which, according to my source and my own observations, uh, uh, if you have a bias against research from firms, especially when they put out buy and sell recommendations, uh, like Goldman Sachs does, I respect that. Uh, Especially if they have their own prop trading desk. But technical analysis, properly done, is neither bullish nor bearish. It handicaps moves. So Goldman's technical stuff is pretty good. Sip of coffee. Okay, let's go through where the market is right now. Gold, spot gold is 1239.90, and February gold is trading about, let's see, 450. So 1244.50 right now. That's a delayed chart you're looking at there, right there. The dollar is lower, which is underpinning gold a little bit. The PBOC injected some liquidity into the market last night. And let's go to that. I think our computer is actually working a little bit faster today. Uh, yeah. So what you're looking at is the reason it has so many flat lines is because this is the onshore uh, uh, Chinese currency, and by that I mean that it's governed by their rule. It's not the offshore float. I'll show you what I mean. The offshore float has more continuity, but this, you always see holidays reflected in that. It's an hourly chart, but you can see after midnight. Well, actually, not after night. When the 17th started, this is Eastern U.S. time, so 1 in the morning for us is midday for them. They did inject, and that would mean they added liquidity. Now, adding liquidity, your initial reaction, anyone with experience in the market, meaning printing money makes a currency worth less because there's more of it, which is true. And now I want you to wrap your head around this if you haven't already, that the yuan is inverted to the dollar. So this is yuan per dollar. So if the yuan goes up, it's getting weaker. So this would be an example of printing money. I mean, they didn't print money, but let's just say that they did for this period. If you print money, you add liquidity, you make the yuan. If you print money and you devalue, let's not say add liquidity, and you devalue or lower the value of your yuan versus dollars, the price will go up. Now, there is something that people don't, I think, quite understand, but it's very important. There is a point, kind of like a Laffer curve setup, where if you add liquidity, it actually strengthens. It actually strengthens the currency. So an example of that would be a currency with a very, very, let's take China to an extreme measure, a currency with a very, very small float. Let's say, they only have $1 worth of float. Now that currency trades very weakly. Let's say to the dollar, it takes 1,000 of them to buy $1, but there's only 1,000 in existence. So that lack of liquidity, okay, or I should say that small float, discourages investors from putting their money in it. Liquidity is the flip side of devaluing a currency. So if you print too much of a currency, you end up devaluing it. Well, you lessen by intention. You are lessening the value of it versus other currencies, or versus what you want to buy, the Big Mac index, for example. So if you find that you need to export more things, you're an exporting country, you would want to lower your currency so that the prices of your goods seem more attractive to other countries. So, uh, uh, you know, a toy made in China that can be sold in the U.S. for $1, once you debase the yuan, is now sells in the U.S. for 80 cents, tariffs aside. The flip side of that, and not talked about enough, but very important, it's just glossed over, is liquidity. When you hear the word liquidity, um, uh, uh, sometimes it's used to mask over devaluation, but sometimes it's necessary. Injecting liquidity into the market means there's not a big enough float for people to be attracted to own it. Why would I want to own this? There's silver and gold bugs out there. Uh, uh, you want to own American Eagles and Toronto Maple Leafs if you're a coin collector. Uh, you don't want to own, the Spider-Man commemorative, because there's five of them out there. Number one. Number two, when you go to sell them, you have to find someone who is willing to take the risk that it's not a fraud, because it's not commoditized. And number three, even though it may appreciate in value, you can't sell it when you want to. There's no on-demand liquidity. So now that you understand why someone would increase the amount of float of a currency, in China's case, it's very important because the more currency there is, the more interest there is in offshore investors to put money in China. And so that is very important to their economy. So to gold, okay? So let's get through this to gold now that I've explained that. That's why sometimes you'll see uh, the yuan could go up. And if you think the yuan's tied to gold, the yuan could go up or get stronger against the dollar, and that's good for gold. But I don't see that too much. So they print money last night, and the yuan weakens, means it rallies, right? Which is what it should do, and then it gives it all back. Now, all things being equal, the fact that it gives it back over these hours, and this is just a little snapshot of 4 hours, says to me that uh, you know they're going to have to do it again, because clearly they want a bigger float out there so they can encourage more offshore investors. Just speculating. But back to gold. Okay. So last week, let's go to the weekly for a moment. A lot of lines today. I'll be removing those in a second. If you remember, 2 weeks ago, we got a buy signal, and then we retraced to this line, not necessarily negating it, but we're now inside of it, and I am concerned. These are my numbers. 1233.80 in Feb Gold is a level for me that would be something that I think you would consider getting short below. And if you're long from 2 weeks ago, you would be considering getting out at 12 um, 39 and change. Not much of a difference. But let's go to a little bit of technical analysis. I'll show you a couple things, describe a couple things, and give you my history with it, and then go through the Goldman thing. But first, maybe today's numbers. Um, Moore's technicals, basically. A break above 1247.50 has a good chance of running back up. These are my words, translating his lexicon. A break above 1247.50 has a good chance of running back up to make new highs above 1256.60 with 1260 as a target. So let's go to the daily, and let's hide all this nonsense for the moment, as well as that. So we're looking at the daily, and he's saying that above 1247 and change, we have a good chance of making new highs with 1260 as a target. Now, um, above that, and there are probably some more CTA stops. They would float gold up to possibly 1274. The CTA stops, that's my top comment. 1274 is his number. But I do have a problem with this, and that is what I'm going to show you right now. This is my one of the very few things I follow. This is, it's on a daily, but I'm going to put it on a monthly now because it's important. This is a monthly level. This is the holy grail for macro funds. Now, when Gunlock was bearish, he said so when the market was here, and the market went there. And when the market went 1200 and below, he got bullish. So it's my feeling that he was long above, he got short out and short here, he covered in this area, and now he's long. I think that there are stops in this moving average area for CTAs. CTAs have been short gold for a while. They're actually been profitable. Play on moving averages with gold primarily, but it's those stops that longs, macro players like Gunlock and Soros will use to as their exits. So if we get, and I don't want you to look at that number, I want you to look at 1268 and 1263. If we get in those areas and you see uh, volatile movement, uh, choppy movement, you'd have to be able to ascertain that yourself. That could be stops being absorbed by uh, uh, macro selling. So you need to create an exit strategy in a market as small as gold, but as predictable in movement as gold, which will bring us to technical analysis. Okay, so, and we'll hide this as well, and that. Okay, so my point to augment or to as a caveat to Michael's numbers are above 1247 and a half, and I'll show you how he derives that number in a second. New highs are on the table above 1256. Now, with 1270, 1274 also on the table. I think we'll have a big problem getting through that 1263, 1268 area, at least the first time up. All right, on the downside, below 1244 should get us 1236 and change. So look between 1244 and 1247 as kind of a dead zone. So below 1236.50, it's another dead zone between there and 1233. So, and you'll notice that 1233, the number that I have, comes in that area. So it's kind of like this. If we break it, right now, we're in between 1244 and 1247.50. So below 1244, you could be short with 1236 and a half as a level to cover. Below 1236 and a half, you could be flat or long if it goes back above. Below 1233, and I think it gets very interesting. That fully negates the signal that I had 2 weeks ago. It also coincides with a more technical level. Any time below that, after anytime spent below 1233, after high volume punctuation or penetration, would augur for 1214 or 1216 before beginning yet another washout to as low as 1202 before we have to worry even more about. The upside, to not be a total party pooper, is that if we do dip in this 1233, 1236 area, and the market comes back through, you'll see like a long wick on a candle. You should be excited about that because then we'll probably have a break to the upside. Remember, it's the end of the year. It's really hard to handicap what players are doing because players are all trading because they have to, not because they want to. By that, I mean it's the end of the year. So people that are getting fired are squaring up their books. People that are trying to lock in bonuses are squaring up their books. Simultaneously, new allocations are coming in. So there may be people positioning themselves for that. And finally, there's going to be redemptions. All right. So it's not all bad. Let's go through quickly a little bit of technical analysis and notes I have. Okay, technical analysis matter in gold more so than in other markets. This is opinion, obviously, but it's based on experience and knowledge. Gold, like all markets, and for those of you, myself included, who hate gold because it doesn't respect the technicals, we're wrong. Gold, like all markets, respects the technicals, just not as fast as active traders would like. Meaning, gold respects the technicals as much as oil, as much as the S&P. It just doesn't do it on the time frame that you want. It may take a week to do what oil does in an hour. I mean, that's when you have a market that has higher volatility intraday, you're going to have more bites at the apple and more chances. So the trade in gold may take a week, but the trade in oil may take a day. An extreme example of that would be natural gas, where you have what's called tipping points, I guess people would call them nowadays. But In modeling, it's jump diffusion. Nothing, 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 and then news. Boom. And as Bryn Kelly and Mike Cohen were talking about last week, cash is king when it comes to natural gas, as opposed to, say, markets like silver. The cash market can really get distorted from futures before the futures catch fire. But that's a conversation for another day. I'd like to interview her and Michael about that. Okay, technical numbers, right? Gold is an emotional market. It's driven by fear and greed. It has a stable, predictable supply growth, which everyone likes to remind us of it. But it also has all the gold ever mined still above the ground. So let's not get too bullish about that. Technicals matter at three levels. They frequently reflect where margin calls are. Channels are an example. So if you see a market that's in a channel, this is at the very basic level. So you have a market that's got at a channel, let's say, all right. So looking at this area where the channel is here, a channel means something. A channel isn't just a technical number because it just looks like a channel. It's a reflection of margin calls. Right? When a market is in that channel, no one is getting a margin call, and you can actually see that people who trade on margin when it breaks out of a channel will stop out because they have to cough up more money. Very, very often you could see, although it's not so clear anymore these days, but that a channel reflects the clearing 21 and margin responsibilities. So channels are an example of technical analysis, a very simple example of technical analysis reflecting the amount of money people commit to a trade. Stoudemire also used to call this pricing supply, but that's for another time. So for now, let's remove the channels, or my crude example of channels. All right, now I want to go to an hour. Technicals also are a handicapping tool for traders to make their own decisions. So technical levels are rejected. They're either penetrated and repelled, or they're bounced and rejected. They're not pinned. So 1250 gets the market doesn't move at 1250. That's not a technical level. That's an option expiration, most likely where, and I won't say that we're manipulated, although it could be possible, where the options longs are weaker hands than the option shorts. So the market gets pinned going into expiration. So technicals are good for handicapping movement at a level. Finally, even if you don't like technicals, knowing what others are looking at and then knowing what you would like to do when a market hits that level will help you see what the market is presupposed to do when levels are hit. By that I mean this: everyone and their mother and their aunt and their uncle have the yellow lines as trend lines on this monthly chart, and they've actually held up well. I'm a fan of lines that have been penetrated and then reassert themselves. But this is a line these are lines that you may not really think much of, but you should, because everyone else is paying attention to them. So back to what we're doing here. Hold on one second. Sorry about that. Okay, so now I should be undistracted. Now let's talk about trend lines, because they're the basic tool for technical analysis. And there are, I've read the Murphy book, and I don't consider myself a technician, but I understand one thing: that you have to not only have a discipline, you have to be disciplined with your use of it. So what I've put up here are two trend lines in gold. All right, that should be a little bit higher. Okay. All right. The first trend line, which is the easiest to observe, is the top yellow trend line descending. That's a trend line that connects two wicks. Now, the way I do it, okay, and I think most people do it, is they'll connect two wicks. Now, some people will look for where there are three or four wicks connecting, and then connect them. Some people will just look at the first two wicks and connect them and see how it extrapolates out. I prefer to connect the first two wicks and then see how it extrapolates out, because I want to see if the market penetrates it. But the key is this: wick to wick, not wick to body. All right. Now, below that, I didn't have my magnetic thing on. I connected, this is a little bit arbitrary. I connected uh, body to body. All right. Some people may go top to bottom. I don't. I go body to body, top to top. All right. And I drew that because I like the fact that we actually went above it a couple times and back through it. So if you're a trader and you have both of these lines, you could use them like this. You could say, if the market, let's say we're trading in this area here, right? If the market goes through this line, okay, and you're short, you could say, I will I will buy my shorts if the market goes above 1247.60, if the market settles there. I'm sorry, if the market trades above 1247.60 intraday, I will cover my shorts. You can use the other line to say, if the market settles above 1245.70, I'll cover my shorts. So what you kind of give yourself is a print stop, which is the higher number, and a settlement stop. Inverted, you could say, if you're a momentum trader, I will buy above this line, uh, and I will sell as it hits that line. Or I will buy above this line because I don't think it's that important of a line, but I'll really buy above this line. The key is this: as Georgie Kaufman taught me, because I was an options guy and he asked me about options, and I'd ask him about technicals. Was I'd ask him what numbers he was using. He goes, doesn't matter. He goes, pick a number. And I'd pick a number. He goes, well, there's my number. That's what I'm going to use. And I'm like, well, and I think a little bit of it was just smoke and mirrors. But he was saying, have a number and stick to it. And if you know the volatility of the market, that is how much noise is in the market, then you can use your technical analysis accordingly. Now, the reason I drew these lines here is because Michael Moore had a number today. He said, if we're trading, if we go above 1247.20, between 8 and 9, uh, and I think that's right here, I drew this line thinking that might be the line he's looking at. So he likes the market above this area. Now I drew this line because I like this. So it would be my feel that this could be resistance, and this could be a launching pad. And so we'll see what happens when we get there. But we're not going through that too much more right now. On the downside, so why don't we just draw one trend line, all right? On the downside, again, we're looking at the hourly, right? He has 1238 coming in, and that comes in, I think, he looks at the hourly charts a lot for his minor formations. It might come in. No, it doesn't. Okay. I'm not really sure where his down. Oh, I think comes in this kind of like this. He goes something to this effect. Well, you get the idea. He draws a trend. He has a trend line. He connects somewhere in here where the market will hit in the 1238 area. And so basically that's his down sloping trend line. The upwardly sloping trend line is the obvious one that you see here. But why don't we take a look at uh, Goldman's technical report right now, and you can get an idea of sticking with gold. Okay. Now, before if just there's a lot going on here. Okay, they're looking at Elliott wave counts, which are very subjective. They're looking at Fibonacci numbers, trends, and channels, and what have you. Well, why don't we just read what's going on? Gold has formed what looks like a bear flag. And a bear flag is a counter move to the primary trend. And by that I mean if this on the right hand side, make this a little bigger. Okay, if this is the primary trend, this is a counter trend. So think about Fibonacci or Elliott wave. This is the trend. This is the relief rally. So it's two steps forward, one step back, or two steps backward, one step forward, or the ratio would be 3 to 1 if you're looking at numbers like Fibonacci. The reason Fibonacci numbers matter is because they're in nature. Look up perfect rectangle, and you can see why Fibonacci numbers 1, 3, 5, whatever they are, matter. But the perfect rectangle, Leonardo da Vinci, it's all related there. So gold has formed what looks like a bear flag, and they're referring to this as a divergence from this formation. Now, these red lines are probably an Elliott wave count, saying that above this level, it could be a Elliott wave count higher, which would be D. I'm not sure what that says there. I don't know, something, and then higher. So they go the primary count is A, B, and then C will be up higher. Their secondary count is A, B, C, D. I don't know if there's an E. I don't know, E. But anyway, that's what they're looking at. So right now they're saying A, this is A, this could be B, all right, with all these little minor counts in there. So Elliott wave says that if we get above here, you would be looking for an Elliott wave count for a higher move. But we're not above there. So if you have a bear flag, and by the way, if these go too far, in general, if they get too long compared to the thing down, then they kind of break this trend and they do go higher. So let's read. Alternately, this could also be a large triangle pattern, in which the case, I don't believe in triangles, but we can talk about it. This could also be a large triangle pattern, in which case it breaks 1260 and extends all the way up to 1350. Okay. So it may sound like they're hemming and hawing or hedging themselves, but they're not. They're just basically saying to you, feel free to short the market. This is what my walk away. My takeaway is I'm going to short it. Or I'm not trading day trading here. This is not a day trader's technical chart. Between it's 8:28. I have to go, but basically, my takeaway is short it between here and 1250, and I'm only nervous if we get above a certain price of like 1260, and we can go to 1350. So between here and 1255, you're shorting it, looking for a sell off that'll bring us down to 1150. Um, uh, so you're basically risking $15 to make 50. But this takes a week to a month to happen. So you can't uh, 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 just focus on this. I'd like to thank Forex Stop Hunter and any of his friends that are on here. I recommend that you follow him on Twitter. And we should continue more with this because I want to discuss Fibonacci numbers. Not necessarily because I know them, but because I have a good video to show on that. But let's just take a look at where the market is. And dollars down, gold is firm and sideways. The yuan is mixed, and 10-year yield is flat to a little bit lower. S&P is down a little bit. I'm not sure what that is relative to fair value, but compared to overseas stocks, it's doing fine once again. So expect this week the the Fed week will probably confirm what Powell wants to do. We'll probably have stronger numbers. You have your levels. Have a great day. This is Vince signing off.